The Indian Union budget was tabled. What stood out? And as investors, what should you be watching out for? We'll be discussing this with Nitin Jain, the CEO and Principal Investment Advisor with Kotak Mahindra Asset Management Singapore Private Limited. Hi, Nitin, and let's get in your overall reading of the Union budget. What, according to you, were the highlights?
Thanks, Mobina. I know Indian budget has always been a very important event for investors in India, and people who track the budget for a long period of time will also note that over the years, the Indian budget per se has lost some relevance because the budget is, as it should be. It should be an event where we look at the revenues and the expenditure outlay for the next year, and it is no longer a policy platform. Although we do see that in budgets, we do have some policy pronouncement. But before we come into key takeaways, let us also put this budget in perspective. This budget it's a budget which is an unusual budget in the month of July. Normally, we have budgets which are in the month of February. Because we had general elections this year, there was a vote on account in the month of February, where the government had actually put out a lot of details. Not going into details, but it had given a broad numbers or a broad contour of what they intended over the next 12 months from an expenditure and from a fiscal consolidation perspective. What we have here is a budget which is going to be there effectively for the next 8-9 months, because we will have a new budget in February 2025. So that's one thing that investors do need to note, that we did have a reasonably good clarity on numbers on vote on account. There is more details in this budget in the month of July, but this is a budget which is effective only till February 2025, where we will have a new budget come through. Now, as I said, we had numbers from the vote on account, and these numbers are more or less kept constant in the final budget that they have presented just yesterday. Let's look at the events which are played between the vote on account that happened in the month of February and the current budget. We had the big event of general elections. Elections 2024 were clearly a bit of a setback for the ruling coalition and the BJP party in particular. And there were increasing demands that they will have to look at some bit of accommodating increasing demands from the rural economy or from the middle class in form of either some financial support or tax relief. And in this budget, there were expectations of that being accommodated. We should also not forget that coming into the budget just a couple of months back, the central bank in India gave a very large dividend to the central government, which obviously led to expectations that there is room to accommodate this increasing demand of higher support to the rural economy. So if you were to look at what was the expectation coming to the budget, the expectation was that the government will do more or less a similar trajectory of spending towards manufacturing and infrastructure. It will walk the path towards fiscal consolidation, and it has the room to manage some growing demands of, if I were to use this word, populism. What the government chose to do was that it did continue on the first two aspects of focus on manufacturing and infrastructure, and it also continued. I would add that it continued in a much stronger way on fiscal consolidation. And while it did do something on accommodating some growing demands of the rural economy, it did not succumb to populism. So that was a big takeaway from this budget. And that could be, at some level, it could be it could be treated as a little bit of disappointment for the rural economy, for the consumption sector in particular. But the government is very clear, the direction of travel is very clear, that they are focusing on creating capacity, they are focusing on fiscal consolidation, and they believe that the rest will happen in the course of time. Now, the key takeaway, obviously, there was one key expectation that when we were going into the budget, there was a growing buzz that the government is going to harmonize the tax structures for various asset classes. And we know in India, equities do have a favorable tax structure against other asset classes. So in that sense, there was some expectation that equity as an asset class could get adversely impacted by changes in tax structure. And that happened in this budget, though the outcome was slightly better than what the market was fearing. But there is that dampener that happened. So if I were to sum it up, this is a budget where there were some key numbers which are already outlined. There is final details on that. This is a budget only for the next few months. We have a new budget which will come in the February of 2025. The direction of travel is clearly the same, and in that sense, there is continuity. We see continuity on infrastructure manufacturing with emphasis on employment, and that emphasis is through the medium and small enterprises. We see aggressive and continued fiscal consolidation roadmap. We were expecting that they would look at 5.1% of GDP as the fiscal deficit, down from 5.6 that they achieved last year. But they chose to even be more conservative, and they are going towards 4.9% fiscal deficit for the year ending March 2025, which is a welcome number. And equity taxation has been a bit of a dampener, though it was better than some expectation in the market. So that's the key takeaways from this budget as you speak.
I want to talk a bit more on those taxation tweaks because it is something that raised a lot of eyeballs. But how would you assuage investors in Indian equity markets regarding these changes in taxation?
So emerging markets do have this risk of policy changes at times. If you look at the last 20-25 years, we have seen capital gain tax structures change at various times. We've seen that earlier there was a capital gain tax which are higher than the current rate of taxation. Then it was brought down to zero. Then it was reintroduced, and now we have seen an increase from 10% to 12.5% on long-term capital gain taxes, long-term being defined as more than 1 year. And the short-term capital gain taxes have been moved up from 15% to 20%, in this budget. So it's part and parcel of policy risk from an emerging market perspective. But it is a clear dampener in our view. India is an emerging market with a very ambitious plan to become a developed economy by 2047. In the interim, 2047 is a while away, but in the interim, there is a very large requirement of capital by focusing towards manufacturing infrastructure. And then we have this energy transition, which will require large amount of capital, both risk capital and debt capital. So in that journey, we would have thought that equities as asset class, where India is deficient from an overall size and quantum perspective, could have not had a higher tax implication. That said, this is a marginal increase in taxation. Yes, it does lead to a little bit of lower outcomes on returns. But I would tend to hope that that once this is changed, it remains stable for a longer period of time, and that could be a positive outcome, that it stays at this level for a fairly good period of time, and that takes away the uncertainty over the next few years on the tax regime. Though I would caution that there is still some gap between other asset classes and equities. I would welcome if the direction of travel is that other asset classes gets a reduction of tax, but you never know that equities can see a further rise in taxation in coming years. But that's a little bit of dampener that one has to account for. Ultimately, I would also think about India on relative terms to other markets. We do believe that India corporate earnings are likely to grow at almost mid double digit for the next 2 years on the back of a much stronger earning growth over the last 3 years. So yes, the market should track earning growth over a long period of time, but this will take away a little bit of return away to some extent.
Some of the key focus areas, for the government in this budget was credit availability for MSMEs. There were certain SOPs as well given to companies with respect to the employment bit. Do you think that this is essentially a way to boost private capex? So far, it's been government capex taking and being in the forefront. But do you think now a private capex will sort of take charge?
So very clearly, if you look at the last few years, the government spend towards infrastructure has gone up quite materially. So if you look at their split of revenue expenditure versus capital expenditure, the capital expenditure component has materially outpaced the economic growth in India for the last few years, and there's a quantum jump. Today, as we speak, 3.4% of the of GDP is now proposed to be spent towards infrastructure from the central allocations. And the government, even in the economic survey, had hinted that while we are doing what we have to do, and we will continue to do what we have to do, it is for the private sector to step up and also participate in both infrastructure and manufacturing capex on an ongoing basis. So this budget in particular has a little bit of tweak by including even the micro and medium enterprises in overall job creation and manufacturing thrust. So in the last few years, we have seen this big PLI scheme, which was outlined to increase the manufacturing and in turn manufacturing capex in India. But PLI by nature was more for larger businesses, larger corporations. And in this budget, they have tried to address employment generation by incentivizing new employment in medium and small enterprises. And in specific, looked at capital guarantee for equipment and then for job creation, supplementing provident fund and some other benefits for medium and small enterprises who create new jobs. And then they have increased the limit under the Mudra scheme, which is targeting the micro companies in India by increasing the amount almost 2x from the current limits. So they are making effort to move away. I should say, add the micro and medium enterprises in the overall manufacturing thrust with a clear focus on employment. In addition, they've also done allocations towards skilling, which will again go a long way in supporting employment. So I think this budget has a special focus on new employment creation by formalized sectors, but with a tweak that medium and small enterprises have been given special focus in the current budget.
Post this budget, would you like to revisit your sectoral preferences or sectoral allocations?
So, when we look at our medium-term allocation, long-term allocation to sectors from a top-down perspective, we take into account some bit of tweaks in policy, and of course, if there's a major policy shift, we would look to realign our portfolios. As I said earlier, this budget, there were some broad indications already given in vote on account. There is some tweaks here and there on certain sectors. There is obviously the capital gains tax that we talked about. There is obviously some more focus on medium and small enterprises. But broadly speaking, there is no major change that was announced in the budget which will make us reorient our portfolio in any significant way. What was expected in this budget, which has not come, is that there is going to be some kind of populism and cash transfers to the bottom of the pyramid, and that could have led to some bit of increase in the consumption basket. Can that be a reallocate money towards staples in particular? I think there is a little bit of disappointment in that count. But that said, that sector itself is going through a little bit of bottoming out. The rural economy is looking to bottom out from a perspective of growth. We see some early signs that the rural economy has bottomed out. We haven't yet seen green shoots of growth in the rural economy, but the sector on consumption is seeing some little bit of bottoming out. So, this support is missing, but I think the bottoming out cycle is playing up. But from our perspective, our focus remains on the sector that we were already invested in, minor tweaks here and there. So just to sum it up, we remain constructive on the financial sector in India. The leverage in the overall system remains pretty low. As we talked about corporate capex cycle that can kick off, that can add to credit growth. The balance sheets of the banks remain very robust. Tier 1 capital remains very strong. On the other sectors that we are favoring, we like healthcare, we like industrials, we like the cycle of real estate, which is playing up. Yes, there was a little bit of peak in real estate, but nothing which is material to impact the new cycle of real estate that is ongoing. We do like the telecommunication industry. Now, we recently saw a major price hike by by players in the sector. So we continue to focus on those in our portfolio. We do have a little bit of a mixed stance on consumer discretionary, not on outlook of the sector, but on valuations. We have an underweight stance on consumer staples that remains. And on global cyclicals, we are slightly underweight because global economic growth is little challenging as compared to local growth in India. So we remain a little bit circumspect on the global cyclicals. So that's the stance which is there. So there will be minor tweaks here and there. Now it's an ongoing portfolio realignment, but this budget is not making us change any meaningfully our views on sectors as we speak.
Now, the finance minister described India's economic growth as a shining exception. What do you think is contributing to India being this standout performer of sorts?
India does stand out from the rest of the pack. If you look at the top 10 economic powerhouses globally, India's GDP growth is almost now on aggregate more than 2x the remaining, barring China. Almost all of them are likely to grow at sub 3%, and we are likely to grow at 6 to 7%. So in that sense, India is clearly ahead of the pack in growth. India has a demographic profile which is very, very positive for long-term and medium-term growth. India has also seen a meaningful improvement in its macro fundamentals, be it current account deficit, as we talked about fiscal consolidation. We have seen a major improvement. I just also want to highlight and use this opportunity to highlight that India foreign currency reserves are sitting at a very strong level. Just in this current month, we had a strong accrual on foreign currency reserves, and we are sitting at now almost at $667 billion of FX reserves, which has made Indian currency reasonably stable. And there is historically the rupee used to be volatile; it is no longer volatile. And we did end up last fiscal year with 8% plus real GDP growth. So India does stand out on multiple fronts, even before this budget announcement was done. Now, in our view, as I said, in this budget, there was nothing which was significantly changing the travel of direction. So the direction of travel, it does not change anything meaningful from that perspective. And I would tend to believe that we would continue to stand out in our economic growth. We will continue to stand out in our improvement on macro fundamentals. And there is one important change that has happened this year in India, from a global perspective for India. India got included in the JP Morgan indices as recent as 28th of June 2024. This is the first time that India got included in any fixed income indices. Thus far, India was an equity allocation within emerging market, but this inclusion of India in the bond indices is going to make India an asset class by itself. So I think that further fortifies India's story in global investments or global investors' mind. And I would tend to believe that India remains very differential over the next 3 to 5 years from an economic growth standpoint. Please do note that we are fifth largest economy as we speak, and by 27-28, it is expected that India will become the third largest GDP in US dollar terms. So that's the trajectory of growth from here on in the very near term. And in the longer term, we do expect by 2030, the per capita income of Indians will almost double from the current levels, and that is a very strong outlook for overall economic growth in the next few years.
All right, and Nitin, let's just summarize this entire conversation for our viewers. Your top takeaways from the budget, and how would you advise investors to read into it?
Yeah, so from our perspective, this budget is a mixed outcome from a market standpoint. There is that dampener on capital gains, while the fiscal consolidation journey is very welcome by the market. At this point of time, there could have been a little bit of support to the rural economy. We know that there is some stress, so in that sense, it is it's balancing out to some extent. We do also expect that this budget by itself will give central bank a little bit of more leeway with fiscal consolidation being brought forward, some leeway to possibly look at rate cuts. So that can be a little bit of positive outcome from a market standpoint. There is obviously this a big expectation that with fiscal consolidation pathway being aggressive, can India go for a rating upgrade? We believe that's a while away. But it's a step in the right direction from that perspective. In all, this budget is realistic, it is prudent, it is conservative, And there is, other than the equity capital gain taxes, there is no major negative surprise from the budget perspective. And as I said, we will have a budget very shortly in February of 2025, wherein I think there is going to be more detail and clarity on future direction of travel. But I think this is a status quo budget, and it's a prudent budget in summation.
All right, Nitin, thank you so much for joining us today and summarizing the Indian Union budget for all of our viewers.